Almost 2 weeks ago, we learned of problems at 2 banks that could have had significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government delivered just that: decisive and forceful actions to strengthen public confidence in the U.S. banking system and protect the American economy. Let me be clear. The government's recent actions have demonstrated our resolute commitment to take the necessary steps to ensure that depositors' savings and the banking system remain safe. Our approach had 2 main pillars. First, we worked with the Federal Reserve and FDIC to protect all depositors in the resolutions of Silicon Valley Bank and Signature Bank. The steps we took were not focused on aiding specific banks or classes of banks. Our intervention was necessary to protect the broader U.S. banking system. And similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion. I believe that our actions reduced the risk of further bank failures that would have imposed losses on the Deposit Insurance Fund, which is paid for through fees on banks. Second, we announced a new facility to provide additional liquidity to the banking system. The Fed's new lending facility, the Bank Term Funding Program, is designed to help banks meet the needs of all of their depositors. The situation is stabilizing, and the U.S. banking system remains sound. The Fed facility and discount window lending are working as intended to provide liquidity to the banking system. Aggregate deposit outflows from regional banks have stabilized. And as you know, 11 banks, including the very largest and some regional banks, announced $30 billion in deposits into First Republic Bank last week. This support represents a vote of confidence in our banking system. While we don't yet have all the details about the collapse of the 2 banks, we do know that the recent developments are very different than those of the global financial crisis. Back then, many financial institutions came under stress due to their holdings of subprime assets. We do not see that situation in the banking system today. Our financial system is also significantly stronger than it was 15 years ago. This is in large part due to post-crisis reforms that provided stronger capital standards, among other important improvements. If there were a failure to raise the debt limit, I believe it would be absolutely catastrophic and take an economy that is performing very well. We've had the fastest recovery from a downturn that we've ever seen, and the fastest recovery of any nation around the globe. The unemployment rate is near a 50-year low. The economy is doing well, and it would threaten all of that.